What if I told you that most CRA reviews are triggered automatically, not randomly, and that one small reporting mistake could quietly flag your return before a human ever looks at it? If you filed taxes in Canada, this video could save you from a stressful CRA letter. Trillium BCG, with expertise in tax filing and consultation, presents this guide. The feeling of receiving an official-looking brown envelope from the Canada Revenue Agency is something many of us dread. It immediately brings up questions and anxieties. But these letters are often the result of a very predictable, automated process. The CRA uses automated matching systems. Employers, banks, investment firms, and agencies send your slips directly to the CRA. The system cross-checks T4s, T5s, T3s, RRSP contributions, and GST, HST filings against your return. If your return doesn't match their database, it may trigger a review or reassessment. This doesn't mean you did something wrong. It means the system detected a mismatch. Today we'll calmly walk through the top 10 triggers and how to avoid them. The unseen mismatch. Missing income slips. First, and perhaps the most frequent trigger, is missing T4s, T5s, or T3s. A second T4 from a short-term job, a small T5 from bank interest, a T3 from a trust. With gig work and multiple investments, it's surprisingly easy to miss one. Every payer sends an identical copy to the CRA, creating a powerful automated check and balance. CRA computers sum slips under your SIN and compare to your reported income. Even a small $50 interest difference triggers a flag. It's algorithmic, not personal. Common culprits: job changes, small self-directed accounts, or slips lost in email. Solution: before filing, log into CRA My Account and cross-reference its official slip list with your records. A 10-minute check prevents mismatches. And that dreaded brown envelope. The gray area: incorrect business expense claims. Personal costs claimed as business, no receipts, or 100% on mixed-use items raise risk. CRA systems compare your expense ratios to industry norms and flag outliers. If most consultants claim 15% and you claim 50%, expect a review. Mixing personal with business is common. That casual dinner doesn't qualify. Claiming 100% of a cell plan used personally is a classic red flag. Rule: if you can't prove it, you can't claim it. Keep receipts or invoices. Legit software, a reasonable portion of internet, client meetings. Not legit: groceries, family travel, non-uniform clothing. Use separate business accounts and allocate mixed use reasonably. Think like an auditor. Be conservative and well documented. The home base: overstating home office deductions. Calculate workspace as a percentage of total square footage, measure accurately. An entire room might be per 15%, a desk corner bursk 5%. Inflating invites review. Claim only allowable expenses. Many ownership costs for employees are off limits. Employees generally need assigned T2200. Occasional emails at the kitchen table don't qualify. If your office is 10%, claim 10%. Not 75% or 100%. Use precise calculations. $1,257.34 looks credible. $1,500 looks guessed. Document your area, methods, and math in your tax records. Precision lowers your risk profile and reduces the chance of a review. Exact figures tell a clear, defensible story. Our fourth trigger involves GST, HST compliance for registered businesses. CRA cross-references income tax sales with GST, HST remittances. Big mismatches are red flags. If income shows $100,000 but GST shows $60,000, the system asks, where's the $40,000? Unusually large ITCs relative to GST collected trigger checks. Personal items or expenses tied to exempt supplies aren't eligible ITCs. Ratios vary by industry. The system scores deviations as higher risk. Missed deadlines, erratic swings, and large variances invite review. Sales of buildings or equipment are complex. Ensure GST, HST, and income reporting reconcile. Prevent flags. reconcile books, match T2125 revenue to GST, keep ITC receipts, and get advice on big transactions. Large charitable donations relative to income can trigger an automated check. Systems compare claims to typical giving patterns by income bracket. It doesn't mean fraud, it means likely verification. You need a valid receipt from a registered Canadian charity. Charity name, registration number, date, amount, and donor name. Donation tax shelter schemes are flagged by pattern analysis. Gifts in kind are legitimate but complex. High valuations may require professional appraisals. Verify registration on the CRA site. Invalid numbers are denied. Keep all receipts together for quick responses. If donating a large amount due to a windfall or conviction, expect verification. With receipts, it's simple. A sudden drop in income while expenses stay high is a classic red flag. CRA analyzes trends year over year to spot deviations. If sales fall, variable costs should too. Otherwise, the system suspects anomalies. Possible inferences: underreported income or inflated expenses. Legitimate reasons exist: heavy marketing, product development, or renovations. Proactively document contracts, invoices, and a business plan. Consider adding a brief note. Be ready to respond quickly with invoices, bank statements, and a clear business rationale, or risk a prolonged audit. Claiming losses year after year draws CRA attention. Expenses must be incurred to earn income, and a business needs a reasonable expectation of profit. Automated systems flag around the 3 to 4 year mark for potential review. A human auditor then assesses viability, effort, expertise, time, and capital devoted. Clear commercial intent looks different from a personal pursuit with tax write-offs. Shield yourself with a living business plan, marketing evidence, pitches, and changes you've made to improve results. If losses persist, ask, is this viable business or passion project? Be careful. Errors related to rental income catch many landlords by surprise. CRA uses data mining and platform agreements to find undeclared short-term rental income. They cross-reference title records, permits, and online listings against your return. Know the difference: current expenses, ads, minor repairs, utilities, versus capital, roof, furnace, major renos. Misclassifying big renos as repairs creates losses and triggers review. Restored to prior condition is current, lasting improvement is capital. On sale, report capital gains. Land registry sales without a reported gain trigger inquiries. Immaculate bookkeeping and correct classification are your best defense. Claiming credits you don't qualify for often stems from misunderstanding. Credits serve specific groups, but have strict eligibility rules. Canada workers. Benefit: if your income exceeds the threshold, the system auto-denies. DTC requires an approved T2201 on file. No approval, no credit. Tuition transfers must be designated by the student and match on both returns. Caregiver and medical claims need detailed receipts and eligibility. Vitamins and gym fees are not eligible. Read CRA criteria before claiming. Complete all required forms for all parties. Diligence upfront prevents denials during automated review. Our 10th trigger: the overuse of round numbers. Returns filled with neat amounts look estimated to CRA analytics. Real-world totals have cents, $487.92, not $500 flat. Analytics spot patterns inconsistent with natural data. Many rounded lines together raise your risk score. Track exact amounts all year in software or a spreadsheet. At filing, transfer accurate sums. No guessing. Precise numbers look authentic and reduce algorithmic flags. So there you have it. 10 common, often unintentional mistakes that can trigger a CRA review. The process begins with algorithms spotting mismatches, outliers, and odd patterns. Do quick cross-checks of slips, receipts, and allocations before you file. An extra hour of accuracy can save weeks of anxiety. Be prepared, be accurate, and be confident in the numbers you report. A review isn't wrongdoing. It's often just a mismatch. If you want a checklist to avoid these triggers, hit the link in the description and subscribe for calm, reliable tax tips. Thank you for watching. Quick clarifier. A review, an audit, and a reassessment are different. Review. The CRA asks for documents or explanations to resolve mismatches. Audit. A deeper examination of your records and processes. Reassessment. The CRA changes your return, which can result in amounts owing or refunds. Understanding the difference reduces stress and helps you respond properly. Keep orderly records and most reviews end quickly.